What I'm looking at here is my position in Soxl, which is the triple leverage chips ETF, and today is trading up. Today is trading actually 5.25% on a pretty sizable daily gain. Now, as you see here, those are my lots, tax lots, and I'm in the green. On my overall position, I own just a little bit over 24 grand of it, of which over 6 grand is unrealized gain. Overall, I am making nearly 33% of my money on it, and my average price is about 46 bucks a share. So I'm carrying it at 46 bucks a share. Now, what I want to do, I want to protect my downside, because being a triple leverage ETF, those fluctuate quite a bit. Let me pull this one up on Seeking Alpha so that you guys see what I mean. Now let's see the chart over the past 10 years. Like you see, it seems like it hits a ceiling. Now here, 2021, the market went up a lot, and it was trading about 67, 68 bucks a share. 2024, it was again trading in the same range, 64, 65 bucks a share. And now February, or rather January 2026, it's approaching those levels. So because I am already making over 30% of my money, this thing is trading, let's say, at 60 bucks a share. If it was to drop to 40 bucks a share, I am going to lose, of course, 20 bucks a share. And there is a good chance of it. If you think of the market as overvalued, or rather, I wouldn't say overpriced, but I would definitely say that the market is currently high priced, okay? And now in that case, I would lose 20 bucks a share. But if I sell a cover call at 40, in that case, I am going to protect my downside, okay? Now this thing also pays a dividend, I think, or it might not. No, it does not. It does not pay a dividend. Sorry about that. But you see what I mean with the fluctuation. So going back at it, if I was to put a cover call in the 40 range, that puts me right in here. Okay, I am going to collect the premium today. I'm gonna protect my downside, of course, and I'm gonna have the extra income to buy more shares and repeat the cycle. And that's what I'm gonna do, because look guys, I mean, like it's been said, the trees don't grow to the sky, and I think that this thing is doomed. Sooner or later this thing is gonna soften up when the AI euphoria is going to calm down. So going back to my E-Trade account, I want to give you guys a real life example of how this works. Now I already have 400 shares of it. I'm gonna sell one contract, which is 100 shares of Soxl. Let me look for the option tab. Okay, direction funds, higher risk, leverage ETF. I'm gonna go under options. Today, January 16th. I'm going to write this one up. I usually do this in a time span of from 3 to 6 weeks. Now, February 13th, that would give me about a month. So what happens here? I'm gonna keep my shares tied up for a month. And I'm going to go strikes. Let me go on all. Okay, this is your strike price. 25 is a little too low. I want to stay in the 40 range. 40, 45, something like that. Now, once again, today this thing is trading at 61 bucks a share. 61. Like, let's say that I'm gonna go to 51 as my strike. 51, I got 10 bucks a share. That's gonna pay me 11 bucks a share minimum. So I'm already making a buck a share on my holdings. Now, I don't know if I wanna do 51, but you get the point. Let me pick one up like 61. This is 47.50. It's gonna deposit in my account about 1,300 bucks. If I was to write it at about 45, well, let's say that I'm gonna write this one at 45. Okay, let's say standing at 61, 45, I've got 16. I'm gonna collect the premium right away, deposit in my account. Now the last trade, I think it was 1704. 45 details. What is this? Okay, this is a $45 call, expiration February 13th, 2026, a month out. I'm gonna sell it. I'm gonna sell this one call 45. Let me see one thing, because I'm carrying those shares at 48. 48. I think I'm gonna go with 48. So in this case, I'm gonna collect the premium and I'm not gonna lose anything on my equity. Okay, so once again, 61, I got 13th. I'm gonna go with this. I'm gonna let it go at 48. One contract, February 13th, strike price 48. Last 1275 market. So if I was to do this, I am going to get about 1350 deposited in my account today. 1350, and it's a 1 month out. Okay, 477. I'm gonna place the order. Okay, the order was placed during training hours, and I am basically done. Now, what are the options here? Okay, if the chips go up a lot, I'm gonna lose all of the upside. None of the upside is mine, but I already have built in over 33% upside of my equity, so I'm not worried about that. What happens here is that you want to write a cover call when you already are up on that one position, okay, which I am. So your upside is capped, but I'm okay with that. I am perfectly okay my shares being called away, because this triple leverage ETF, it is not a good strategy. Is for a short-term trading. Those are usually for daily, weekly trades, because if something was to happen to markets, this thing is gonna plummet. So in order to protect my downside, that's what I'm doing. Now the good thing here is that I'm gonna get 1350. I already did deposit in my account that I can use for whatever I want. And what I'm gonna do, I'm gonna repeat. I'm gonna buy possibly with this a little bit more share of either the same ticker, or I'm gonna buy some of the TQQQ, because that's primarily the top two leverage ETF out there. I believe that they're hot and with volatility, and you can make big money with those. Now, if the stock price was to go to 48, basically I cap my downside, I collected the premium, and I repeat, and I'm gonna buy the same shares again. Now, if this thing was to drop to 30, I'm okay with that, because possibly the buyer is not going to exercise the option. And guys, there is a huge chance that the buyer is not going to exercise the option anyways. Even if this thing is going to drop to 50, 51, I don't know if it's worthwhile to the buyer to buy my shares at 48 when they're already paying for the option to buy at this price. So I don't know how much money they've got into the call option that it's not even worth. So if the stock was to drop to 50, they can buy to the open market at 50 directly, or they can buy my shares at 48. But again, I don't know how much money they got invested in when they bought the call option to have the right to buy on 48. So I'm okay. This thing can drop all the way to 45, 44. I'm perfectly okay. But even if it was to drop to 30, they're not going to exercise the option. I am going to pocket the whole premium here, and I can repeat. I can now buy the same ticker for $30 a share, which is, let's say, cheap, quote unquote, compared to the level it's trading now, and I can repeat the same thing again. Now, if you want to take it to one step up, you can write, or rather, you can sell puts. If you are sure that this one ticker is going to drop in the 20s or in the 30s, you can sell puts at the strike price. If it hits your strike price, you are obligated to buy, but you're going to buy at 20. You know this thing is going to go back up eventually. And repeat. And once you get a hold of those shares, you can sell cover call against those shares again. So now that's what's called the wheel strategy. But you don't even have to do that, because a lot of times you're going to have your cash. If it is a cash secured put, you're going to have your cash tied up for the next 2, 3, 4 months. And why would you want to do that? And the premium, when you sell a put, the premium is not that much. You're going to make a whole bunch of a lot of money selling the cover call. But again, there are people who do it successfully. They sell puts, they are assigned the shares, and once they do, they sell cover calls against it. I don't want to keep my cash tied up. I would rather buy shares with consistency at an average, let's say, pace, dollar cost averaging into those shares. At that point, when I get to 100 shares or more, if I want to sell more than one contract, I'm going to see what is my average price, and I am going to sell cover call against it and generate income like this. Guys, if you're doing this strategy, you are focused on the premium. You're not focused on the appreciation of your stock. Also, because if you sell cover call out of the money, the premium is not gonna be that much. You're gonna be your upside cap, and really I would rather sell in the money or right at the money, or deep in the money. It depends on the market conditions.